Welcome to this webinar series, which is a part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. The World Investor Week just came to an end, but the celebrations will continue for the month. So, to celebrate this occasion and in an attempt to spread financial awareness, we have picked a topic that is usually on every investor's mind: how to be a smart investor. This question is especially relevant to the younger population that is entering the investing arena with full verve. We have all seen the number of demat accounts rising, and a lot of them are new investors. To tackle this subject, we have a panel of three experts today who will tell you what a smart investor should keep in mind and who is really a smart investor. So let me introduce the panel to you. First of all, I would like to welcome Mr. K.S. Rao, who's the Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao has been striving to take financial literacy and investor education to various demographic segments across geographies for over 30 years. We also have with us Mr. Amit Trivedi, co-founder OSAT Knowledge Private Limited. He's authored a number of books such as Riding the Roller Coaster and Money-Wise Perspectives for Women. Last but not the least, our third panelist is Mr. Suraj, founder and master coach for the Sales Accelerator Program at Reflect and Grow. He has been a part of the leadership teams at key AMCs in India and has worked relentlessly to market the SIP concept in the country. Welcome, gentlemen. So, starting the discussion with Mr. Rao. Mr. Rao, as we celebrate World Investor Week, could you list 5 things that can make investors smart, so to say?
Thank you so much, Nidhi, for having me here and glad to be part of the wonderful panel around. Before I start, let me also officially congratulate for having done your Delhi conclave and the retirement 40 after 40. It's one of the best and the finest. And
Thank
I
you so much.
congratulate you and Outlook Money for taking this initiative. And the way it has created vibe in the capital city, I'm sure it will go across the country and we can see those vibes coming in. That's the first part of it. Second part coming to the topic, and it's a celebrating World Investor Week. I think probably October is a month. Looks like it's a month of celebrations for all of us. I know it's either it's a Navratri, Vijayadashmi, World Investor Week, and we end up with a Diwali. And then if I can look at into the system, how the smart investor need to work is we started with that Navratri. It's all the 9 days we worship in the goddess in a different format, and either it's a Lakshmi, Durga, or Parvati, and the smart investor is the one who gets himself educated well and who got that courage to navigate the rough seas, and where you have a courage from Durga, and then you get that goddess Lakshmi where you need to manage it so well, otherwise it will not stay away with you. Then you have that Vijay Dashmi which is coming in, and then that will lead you to Diwali celebrations, to put it in Indian parlance. But coming on the World Investor Week celebrations, I think I really congratulate IOSCO for doing this, International Organization for Security Commissions, and SEBI is active participant. And in the last few years, year after year, we are celebrating this. And incidentally, this happens around the World Financial Planning Day, which has happened last week. And I mean, now in India, we are celebrating from 14th to 20th. And this smart investor definition is reasonably little getting changed, but it is getting modified in a very different way. And I think this is the third year in a way IOSCO is talking about smart investing, but the underlying constituents have undergone some change. One, they said this time, incidentally, it has gone to the basics of investing. Probably, after seeing the rallies across the world and, euphoria when is coming in, you need to go back to the schools. And during good times, we are deaf to the risks. During the bad times, blind to the opportunities. And, today everything is good, and time to look at how the basics of investing. And the second part, it was also talking about technology and digital finance, how it is shaping up and how you can use it. Third one, it is looking at is protection, the fraud. I mean, there are many scamsters. I mean, overall, it is like, enhance the savings, convert into investing and giving that investor confidence across the globe. And when you asked for 5 things to elaborate, probably I can look at the first. First is what smart investors needs to do is, he or she need to take informed investment decisions. And I put it again in Indian context. The smart, normally we will define specific, measurable, accomplish, achievable, and those realistic and time frame. But here the smart investing in Indian context, especially it's we are looking at Vikshit Bharat in next 20 years or so, where we are becoming a developing nation. And what is that I need to do is how I need to stay put. And if somebody is looking at last SEBI's data and F&O, 95% of the people losing out, and it's last 3 years amounting to 1,80,000 crores, which is equivalent to little more than our SIP book we got in the last 4 5 years. Means the amount of wealth people have lost. Then the first
Hmm.
thing that as smart invest, I put it since it is five, you said, I put it in acronyms, SMART. The smart, the S is, I call it as a Shikshit Niveshak for the Vikshit Bharat. You need to be a Shikshit, you need to be continuously educated, continuously empowered. Probably I congratulate here again Outlook Money for making that happening. And I see every issue which gives a different perspective and gives the understanding. That's the first part of it. Second part of its market is always volatile. In the last few years, what we have seen could be little different, and every asset class is doing well, and it may or may not so many a times. And managing the volatility is the most important part. I refer Amit's book, Riding the Roller Coaster. It's how you need to manage the volatility. And managing the volatility is, most of the times managing your own mind. And since today we are also talking about the digital infrastructure, which gives the comfort of ease of investing and also ease of disinvesting. And you take a decision so fast, then you do a blunder, because your informed decision is not informed, but it is instant decisions. Managing volatility is the second one. Third one, I call it as an asset allocation. That becomes very crucial, because asset classes, when it is, I mean, today, if three of the asset classes are doing pretty well, but when things will change, we don't know. And it's balancing those assets are most important, and investing rightly is the third parameter. And the fourth parameter is last 3 years, we are looking at too much of returns. I mean, when I go and address a lot of people across, I mean, I met a woman in Chennai. I mean, Chennai considered to be a very conservative town. And she said, my fund has given 34% in the last 2 years. Kindly suggest me where can I invest, where I can get more than 40%. Means, this is a time you don't need to, I mean, people are looking too much of the returns. Understand the risk before the returns, or risk versus the return. That's the fourth parameter. And the fifth one I can look at is, I mean, thanks to Suresh sir, who is here, I call him as a father of SIP here. I mean, who is the one initiated so much, is a proponent of SIP, and maybe SIP today is a Suraj initiated planning. And it's a way I look at, and it's a timing the market at time the market. I mean, you are like, time in the market. This SIP has helped the people to, I mean, don't know to time. You are always in the market. You don't need to worry. Means effectively, I put it as a Shikshit investor for the Vikshit Bharat, the managing volatility, asset allocation, and risk versus return. Last one is the time in the market. And this is the five variables I look at.
Great, great. That was quite a holistic answer, like Mr. Rao is known for. But he was also talking about the World Investor Week is also about basics of investing. So I'll come back to that. And Mr. Trivedi, I'll pose this question to you on what are the basics of investing that every beginner should know about. And why I'm saying beginner is that, while the number of demat accounts has gone up, we also know that a lot of them have been opened by new investors.
The basics of investing is that you are investing for a purpose, and that purpose has to be defined. I mean, that's the first step. A lot of times people fail to define that purpose, and just put that point in a slightly lighter vein. When I do a presentation in some of the companies and I ask the youngsters, why do you invest your money? A lot of times I get the answer that to save tax. So I have a wonderful, ethically correct, morally right, legally approved strategy to bring your income tax liability to zero. And they would say, yeah, please tell us. Okay, quit the job, no income, no tax. So if you define a wrong objective, there is a guarantee that you'll get wrong advice. So define that objective, define that purpose very, very carefully, spend more time on that. That's the first part of investing basics. Once you define that in line with the kind of life that you want to live, then you put together where you are right now in terms of your financial position, your mental state, your ability, your willingness to take risk. So you put all these things together. So now you define the destinations and you define where you are. Now, the third step is to drawing up a plan to reach there. And believe me, the road to that destination is amazing. If you to go short distance, then you got to go slow and the road is smooth. But if you to go long distance, you got to go fast, and that road is full of roller coaster rides. So, it's amazing that a lot of times people miss out on these basic facts that for short-term goals, you do not want to lose money due to volatility in the markets. So you keep money with safer investments. But longer the term, you can't play that safe and only focus on protecting your capital, because there protecting the purchasing power becomes far more important than protecting the capital. So if the goal is short term, the requirement is short term, protect capital. If the goal is long term, protect the purchasing power. Then what Rao sir was mentioning comes in, that you diversify across various asset categories. There again, a lot of times people don't realize that if I diversify, what happens? So many discussions you hear that, no, I have a mutual fund portfolio, but this stock did better. Obviously, at any point in time, one component of a diversified portfolio would grossly outperform the average of the portfolio. But we miss out that some part of that portfolio has grossly underperformed also. And diversification is a strategy to safeguard against the downside or against the risks, rather than capturing the best possible upside. So the idea is not to win a 100-meter sprint. The idea is to complete the marathon. And then that's the real difference. So when you look at the basics of investing, once again, to sum up, start with a purpose, spend a lot of time in defining that purpose very carefully. Then take an inventory, take a stock of where you are, and then draw out a plan. Now, for short-term requirements, don't take risk of volatility. For long-term, protect your assets against inflation. And in the entire process, diversify the portfolio. Having said that, when you want to go long, it's like, the great Sunil Gavaskar used to say, stay on the wickets and runs will come. So you got to stay on the wicket also, which means the risks which are present, you got to buy protection wherever possible. And that protection comes in form of contingency fund and insurance. So start with that. And then only you'll have the financial ability to stay put for long. And that, according to me, is the basics of investing. Once somebody understands this, then at least the portfolio can be constructed. But then comes the biggest problem. And that biggest problem is something that I see daily in the mirror in the morning. That's myself. I'm the biggest risk to my portfolio. And how do I protect myself against that risk is a bigger question. And for that, majority of the investors would benefit by taking professional help, be it an investment advisor, a mutual fund distributor, whatever name you want to call. Take that help, because this person would at least ensure that when the kid goes into the candy store, the kid eats only the amount of candies that is required and does not go here and there and create havoc in the candy store. Okay, so we stay focused on the goal that is done by this particular person, a professional. So take professional help is the final word as far as basics are concerned.
Right. So you had the basics of investing, listed by Mr. Trivedi very nicely. But coming to Mr. Kailey, and Mr. Rao was earlier mentioning that, people have faced so much losses in trading, and we have had that SEBI study also saying that. So when it comes to investing, of course, we all know that patience is the key. But beginners are often, they're seen in a hurry to make money, and in fact, they end up in losses instead. So what will be your advice to them from that perspective, from the market perspective?
So Nidhi, I'll start with a confession that when I started my career, I was also like this new investor wanting to multiply my wealth very quickly. And it's only after you lose some money that then sanity prevails and you start realizing that it's not a straightforward game. And what is very crucial at this point is that you don't do so much that you can't make a comeback. That is where I think the risks really multiply. But having said that, when I look at my own investing journey, I have also leveraged early on in my career, lost money, and then realized that that's not the way to go forward. But having said that, the most important part, when it comes to really preventing against your trading losses or something like that, is the fact that if you realize that, there are different pockets that you make of your investments, right? So I've never been against trying out new things, because some experimentation is a part of being a smart investor. Because if you don't experiment, how do you learn? So I always believe that create pockets, right? So you have something like, Amit also mentioned that always have some protection money. So you have some for emergencies, you have that. Mr. Rao put it very beautifully, the 5 aspects of smartness, which is the completeness that we are talking about. And eventually what you realize is that if you develop these buckets and you keep an open mind to learn, that's how you really evolve and become a better investor. So I always believe that, even when 100 years back, there were no stock exchanges, no financial assets, investors were smart, right? And so the smart investor at that time knew that you have to navigate your day-to-day living, and till you can do so till your retirement, end of retirement, I think you've done a great job for yourself. So I do believe that driving the balance is the key way to manage, and it's okay to lose some money, but come back and do the right thing eventually.
Okay, that's a great thing. But nevertheless, this mistake happens. And of course, there is a learning in it, and a lot of people would experiment and learn from it. And that's one positive aspect. But trading is a mistake, but there are other mistakes also that investors make. Mr. Trivedi, what according to you are some of the common mistakes that investors make, but they should steer clear of it?
So let me divide the entire group into 2 parts. One part is ignorant about the subject of investing, and second part is the people who think that they are not ignorant, but in reality they are ignorant about their own ignorance about the subject. Okay, so first part does not want to change out of ignorance. They do not want to acquire knowledge, and that's where some tipster saying something, somebody making money, some example of somebody, some influencer saying something, and they would jump without even questioning how was it possible that some of the greatest industrialists have never claimed to offer a double-digit return out of their businesses, and a 24-year-old or 25-year-old would come and jump here in front of the YouTube camera and say that you can make 30%. On what basis do I believe? So I don't even question that basic thing. So that's the ignorant part. And in the process, in order to chase the high returns, they end up making bigger losses. So this is one part. The second part is where some knowledge is there, some success is tested, and that small success feeds into the confidence that one already had, and then that confidence turns into overconfidence, and sooner the overconfidence turns into arrogance. The moment it gets into that overconfident, arrogant territory, we lower the guards, which means the risk management processes go out of the window. So instead of diversifying, we'll start taking concentrated positions. Instead of doing a detailed evaluation, we'll look at shortcuts to arrive at, so take for example, suddenly somebody would come and say, there's a rally in mid-cap stocks or small-cap stocks. So if the company happens to be in the small-cap category, you just simply buy it. No, it doesn't work that way. The company has to be individually on its own fundamentally strong, and the stock has to be reasonably valued. Then only you'll make money. Just because it is mid-cap or small-cap, you don't make money. So we take those shortcuts. The classic example was during the 1992 boom, the great Indian securities scam. At that time, Mr. Harshad Mehta mentioned about one company. Sorry, Mr. Harshad Mehta bought some stake into one small NBFC, and that company had a name, word Mazda in the name. And shares of Suraj Mazda, a completely different company, went up. right? So that's a shortcut. Harshad Bhai is buying Mazda, let me buy Mazda. And that's a lot of do with overconfidence that I've got that Midas touch. Whatever stock I touch will jump. Now I'm repeatedly saying stock, but it applies to any investment. It happens in real estate, it happens in startups, it happens in it's happened in fixed income markets also. Everywhere. The moment I start believing in my abilities and start taking credit for what is not due, I tend to get into that trap of lowering my guard. And the moment the guard is lowered, the risk makes a very quiet entry. It does not make any noise when it enters. And after that, we only make noises that somebody did something, I was always right. So the basic mistakes to me are, one is ignorance, and on the other spectrum, it is confidence, which turns into overconfidence. These are two primary mistakes. Everything else then boils down to taking shortcuts. Behavioral finance highlights some 50 or 50 plus biases, but at the core, it eventually gets into this. Now, emotionally, if I see, then the largest emotion, the strongest emotion is the fear, the primary emotion, fear. A lot of times we keep talking about fear and greed, but greed is actually the other side of fear, which is fear of missing out. My neighbor got richer than me, so now my Mercedes looks like a Nano. And that's what Mr. Rao was mentioning, that I have got 34%. Can you show me something that can give me 40% plus? 34 is far more than most people can imagine. Just to summarize, three things that we need to be wary of: our own ignorance, accept that ignorance; overconfidence. The moment we accept our ignorance, it'll keep a check against that overconfidence. Don't start taking credit for where it is not due, and ensure that when you succeed, you analyze what was the reason behind that success. And most of the times you'll realize that you were not the reason. You happen to be the beneficiary who rode the wave. And third, fear. Now, fear can be divided into two parts. One, what they call the biological fear, the fear of death. And second is a psychological fear, which is, which is what Daniel Kahneman also mentioned in the Thinking Fast and Slow, right? Now, when you look at these two fears, the brain actually fires the same chemicals and same signals in the event of both the fears. So if to take a simple example, if the stock that I've invested goes down, or the property that I want to sell is not selling, it's the same chemical that gets fired when I see a snake in front of me. When a snake is in front of you, you don't think and analyze, you simply run away. But if a stock price goes down, you got enough time to sit and think and analyze why it has gone down, and you can take a call. You don't need to hurry. And that hurry, in the greed side, when somebody puts a gun on the head and says, last opportunity, yeah, it's the same chemical that gets fired. So stay aware of these things. And again, I'll go back to taking professional help. Whenever you are going through these kind of things, take a second opinion. Take that opinion from that advisor. It will help.
Right. So we have spoken about the basics of investing, what smart really means as defined by Mr. Rao. And of course, Mr. Kailey talked about how one should be careful in the stock market investment and treat it as a learning, perhaps. So now we come to the second part of the World Investor Week, which is talking about technology and the rise of technology and how it affects investments. So, Mr. Rao, technology and digital transactions has made investing easier, of course, but the digital medium also presents some unwanted advice. So, how does one navigate this?
Thanks, Nidhi. I mean, again, kudos to IOSCO for thinking on this angle. And last, post-pandemic, I look at, or in Indian context, we are the leaders in this space. And I mean, either demonetization made us to get the ease of doing and getting into this, whether you have got lot many online platforms today and you have many of the mobile apps, and there were we are talking about those robo advisors, and UPA has made life much more easier for every one of us. And today, incidentally, on the positive side, you also have a portfolio performance tracking tools for somebody, an advanced investor, or there are analytics which is used by either individuals or at organizational level. And life has become easy today. I mean, we boast last month at a 5 crores of new investors at mutual funds today, because Aadhaar based KYC has made and helped us to reach out to the last corner. And incidentally, Amphi data shows to us 95% of the pin codes today we have reached. All of these things have given comfort to the people, which is giving a ease of access or speed of transaction or improved accuracy, or it's also coming with a lower cost. And before even coming to the influencer, I can say now the challenges we face on the broad digital space. One could be a data theft, which is prevailing very big. And the number of unknown numbers you get, the calls you get, and the links you click, and people paying the price for it is much higher today. And people need to be aware what to do and what not to do. Probably today what not to do is more than the what to do kind of it. And there is a data theft, there is a, I mean, even you can see globally the system hackings are happening. That's a, I mean, this also shows, what you need to do is, even you need to keep a physical data of what you are as an individual. For my company, for tomorrow morning, if Mumbai is not functioning, it works from the remote location and it gives it. But as an individual, if I have my systems got hacked and my data is gone, and how do I claim? Probably I need to put my all certificate, all numbers at one place and keep manual data of it. And then the identity theft, or the phishing and scamming, which is becoming very popular. And today, when it comes to the unsolicited advice, when you spoke about, and when and it's like, you can easily get it, any advice which is coming freely, please ensure there is somebody else is getting paid for it. And there's advice which is coming on the YouTube channel, or advice coming from someone is giving, and it's a free of cost advice, you need to think twice. And something coming, or it is from the like also unregistered source. If I'm reading Outlook Money or some good economic daily, then I know these are the publishers, these are the reputation they have. And today there is somebody who is coming in, as Amit ji was talking earlier about, I mean, somebody gives the guy who is not even 25, 26 years, and he says he has done the world. And Suresh sir or Amit ji, or most of us who are with the decades of experience, we feel we are novice, in the sense, I mean, then people need to think of it, why this is coming in, and we are tempted. I have also privy to some of the people who have lost tons of money, I mean, not so small money, in the Telegram channel which is created. I was sharing with you some time back when I was in Mumbai with you. It creates the professor who is suggested this and invested, and they could never withdraw. Means the red flags which are coming to the investors when the
Yeah.
influencers are coming. Just see whether somebody is promising the guaranteed returns, high returns, which is not possible. And then somebody is asking you to invest today, then tomorrow you are making pressure to complete before 2:30, then that pressure, please don't take it. Just knock off that pressure. This is not for me. I think yesterday myself and Amit, we were on a conversation. We are looking at, you don't miss the bus, you get the next bus. Don't worry about it. And it's your money which is most precious of it. And when the advice is coming, there is no transparency, there is no banking, no backing, no regulatory, then you need to get knock off. Third red flag where you can look at. And just look, somebody is giving an advice, is he or is she registered or unregistered? And then then you can knock off. And the fifth one I can talk is, somebody is not disclosing the material facts. Like, for example, I can say I am holding this stock. That was the message used to come. I remember one of the ex-chairmen of SEBI, who was talking at the offline when I met him later part of the studio. The guy who is guiding somebody to buy something, and he has asked others outside, go and sell these stocks. That is the way you look at. I mean, then how to get those people knock off. That was and that is where a couple of videos were created by the then chairman. And just look at those things. And another one I look at is, as I said, as a Shikshit investor, research before you are investing. Also take a filter when somebody is guiding how much it is useful to me, how much it is not useful to me. In the information world, I mean, I was talking to someone yesterday, the relaxation has become relaxation. People are watching the reels, they think it's the relaxations, right? And it corrupts your mind. And just
Yeah.
do the research. And then I mean, Amit was talking earlier again, take the professional help. That makes a lot of things much more easier, and you don't need to take any risk of it. Means, then I think it's the SEBI has come with one slide sometime back. I remember it is called Finfluencers. Stay aware of Finfluenza, the words they used it. And then they timed it in, like, somebody promises the phantom riches, and somebody have a source credibility issue, and somebody want to create a social consensus by by putting so many messages around. And then you need to look at, and somebody also creates a scarcity. You invest today, probably keep those red flags. I mean, as an investor, it's your money. And probably again, go back to the first one. I can, when you talked about basics of investing, if I stick to my goals, if something is happening around the world, doesn't matter to me. I need to stick, and I don't need to get to that unsolicited advice. In case you have too much of adrenal pumping, probably keep 10% of the money, and you lose that money and enjoy your 90% in a proper way.
Right. So again, diversification and being careful is very, very important, like Mr. Rao said, and it's very important when you are in the digital domain to steer clear of this unwanted or unsolicited advice. And you have all the details from Mr. Rao. But when we are talking about digital investing or transactions, we can't but, of course, Mr. Rao touched it briefly. We cannot but discuss the cyber fraud issue also. So, Mr. Kailey, cyber frauds we all know that they have become extremely common, and digital transactions can be at risk if one is not careful. So, what are the steps that one can take to avoid these?
Yeah, so cyber fraud has become such a big issue, and I think the scamsters have evolved so much that every single day, when I read, I find there's a new way of, getting scammed. So I think as the market is learning that there is this issue, the scamsters are also figuring out that they need to evolve, and they come up with new and new stuff all the time. But having said that, I think the most important skill, if any investor can really build, is the ability to discern. See, whenever there's an information that's sent to you, whenever you watch it on, a Telegram channel, it can happen through any manner. Your ability to discern that, okay, is this something, which is coming from a credible source? Is it something that I need to really reflect on? Is it promising me something that is very unrealistic? So these very basic elements, one need to build in. So just to give you one simple example, in fact, my wife has been getting a couple of these calls, on a regular basis. And I always tell her that don't even get into that first minute of engagement, because you may find that your voice gets cloned. And suddenly you find that somebody is using your voice because now you have got onto the other side. So now this is not, so that there's a scamster on the other side. So the best thing is to just cut it right there. Don't even get into that next alphabet or a discussion on them. So my sense is that I think investors have to become very, very, very about, any content that comes to them through any source, and, have the ability to discern that is it really something that I need to engage with. And the more, so for example, we've been reading about don't click on this link, which is coming to you, don't react on somebody saying, okay, it's promising unrealistic returns. Don't give your OTPs. There are so many do's and don'ts that we are talking about all the time. But I think the common thing that is, binding everything here is your ability to discern and stay away. So if you know that there's something wrong, so if, for example, you get on a WhatsApp, immediately block that number. Don't allow it to fester and, say that, okay, next time I'll do that. And wherever appropriate, I think we should report it to the competent authorities to take suitable action. So I think the investor has to be really aware of what's happening around them and be very conscious of, how they act in a particular situation.
So I'm also seeing that just like Mr. Rao said, that stay away from unsolicited advice, perhaps stay away from unsolicited investor content or any kind of, those links and calls, etc. So if you are not initiating it, perhaps it's best to stay away, and that can help you to a large extent. So coming to the end of this session, which was very, I think it can be very helpful for beginners and mature investors alike. One last question that I want to put to all of you very briefly is that one quality that according to you defines a smart investor. And we can start with Mr. Rao.
Yeah, thank you so much, Nidhi. I mean, I'll take from you when you said unsolicited information from the source which you do not know. I mean, probably it's a fabulous way you put it, and I mean, SEBI has also come out with a fabulous website and the kind of content there we have. Any investor can go there and start your basics from the regulator. Then they can come to OLM or or AMFI or to the ABS LMF or any website which are the registered entities. Then you get rightly educated. Otherwise there is a possibility you get wrongly educated and you made to believe everyone is talking. I mean, keeping that aside, when you said one quality, probably I look at that one quality is, I mean, you as a person, you have a financial goals and stick to have your financial goals, stick to those goals. I mean, once you have a goal, then you have a plan for it. I mean, there is a fabulous saying which says is plan purposefully, prepare prayerfully, and pursue persistently. And once you have that plan, then you can have that process, then you can prioritize, and then you can go with it and have that patience. That's the way I look at the planning is the most important part.
Okay, great. Planning is the most important. Mr. Trivedi, for you, one quality?
Rather than quality, I would say what a smart investor must do: read, read, read as much as you can, so long as possible. Read physical, printed stuff, uh, because the electronic stuff is easily available, but it also causes a lot of distraction. So when I look at my own reading habits, uh, I read a lot of books and magazines, but when I shifted to Kindle, my retention reduced. So then I shifted back to books. Number two, when I surf online to read, I often find myself unnecessarily, clicking on various links and going from here to there rather than staying focused on what I want to read. So that old school physical printed stuff, I find it better if the objective is to learn more. And what I realized over the years is that all successful investors, all successful business owners, they are readers. Now, when you read, also ensure that you read contrasting views. Don't only focus on one type of view. So there also diversification helps. And when you read different and contrasting views, and then you form your own opinion, most of the times you'll come out winners. Because that, if you keep reading, again, I'll take it back to the overconfidence bias. If you keep reading about the same thing again and again and again, it will only add to your overconfidence, because I've read something, now I formed an opinion. Now somebody else also confirmed that, so I'm becoming confident. Then somebody else also confirmed it, and it keeps feeding onto my confidence. So you got to see the other side, so that that belief also is questioned by somebody else, and it keeps you under check. So that's what I would say: read, 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 and read contrasting views.
Great. Mr. Kailey, what about you? What do you think is the quality that makes a smart investor?
Well, in my opinion, a smart investor understands the fact that everything in life is successful teamwork, right? Without teamwork, you don't get anywhere, even in investing. And I give you the best example. We all look forward to fund managers and their views on the markets, right? They construct the portfolios. But you ask the portfolio manager what got them the success. They'll say, oh, I've got a team of research analysts who are supporting. I've got a group of traders whom I work with every single day. Because the market is so large and vast, right? And there is so much of information to be absorbed that without teamwork, it just doesn't work. So whether you team up with a financial advisor, a distributor, a group of your friends that come together and discuss certain issues, it is very difficult to get over your own biases and form opinions, which can really help you in investing. So I do believe that smart investing is also about very good, an openness to teamwork and collaborating with others.
Right. So the three things that make a smart investor, very briefly, of course, we have delved into a lot of details during the discussion, is planning, reading, reading a lot in a diversified manner, and teamwork and collaborating with others who may again have differing views, so that you have a you can come to a balanced conclusion. So thank you so much, gentlemen, for this the interesting conversation and very informative conversation for investors. Thanks a lot.
आपको कई मैसेजेस आएंगे, गेट रिच क्विक ग्रुप्स का हिस्सा बनाएंगे,
डबल रिटर्न्स की गारंटी देकर विश्वास दिलाएंगे। ये नकली है या असली, भारत फर्क पहचाने।
कुछ इन्फ्लुएंसर्स रोज नए वीडियोस बनाएंगे,
अमीर बनने के शॉर्टकट्स बतावेंगे,
बड़े बड़े सपने दिखाएंगे। ये गलत है या सही?
भारत फर्क पहचानेगा और बनेगा देश इन्फॉर्म्ड इन्वेस्टर्स का।
This World Investor Week, visit mutualfundsahihai.com and pledge to be an informed investor.
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.